Let's talk about the credit ratings of the big Canadian banks. Fitch Ratings expects that those financial profiles will remain broadly, quote, neutral next year with flat profitability. We've got more from Maria-Gabriella Khoury, Senior Director at Fitch Ratings Canada. Great to see you, and thanks very much indeed for joining us.
Thanks for having me, Andy.
Just to start off, you rate all the big banks as AA minus. Obviously, a quality credit rating, but broadly speaking, how good a credit rating is that?
So the credit ratings of the Canadian banks are all on a stable trend, with the exception of TD Bank, which we currently have on negative after the as a consequence of the AML issues that came to light last year.
Right. And you don't, apart from TD, which you're watching with some caution, you don't see a major deterioration, though, for the industry next year, even with mortgage renewals maybe troublesome?
And that's what we highlight in our report. We do expect the sector outlook to be broadly neutral. There will be some pain points, call it last year, but the banks enter this period with quite resilient financial profiles. Delinquencies are still very well managed. We do expect them to tick up a little bit next year as this first cohort of pandemic-acquired mortgages start to renew. But with the lower interest rates and some of the changes that we've seen in terms of mortgage portability rules, et cetera, that's going to ease some of these pain points.
It's interesting, you don't really see much profit growth, if any, for the industry next year.
Well, we do. I mean, top line growth, we do. We think there will be some easing given the latest also Bank of Canada rate cut yesterday of 50 basis points. So the net interest margin is expected to improve as funding costs become lower for the Canadian banks. Mm-hmm. However, it's the lending volume that we're looking at. We don't think it will be as robust as this year's lending activity.
Right. And then you expect overall profitability to remain flat next year?
Effectively. I mean, the banks did quite well by going through a lot of the efficiency schemes this year. So they did a lot of that spending upfront, and that's going to turn into some good operating leverage in 2025 and 2026. We expect the banks might have to spend a bit more on shoring up operational risk, be it in terms of reporting or audits, or as OSFI continues to look and tweak on the non-financial risks.
When institutional investors buy big bank bonds, I'm assuming they think, well, I'm not taking on too much risk here.
It is, and the Canadian banks are within the higher rated category within our global rating universe. They are, as you mentioned, all within the AA minus category. National Bank is A+. Mm-hmm. But they are a sound for the institutional investor. It's a sound financial services industry.
The National Bank, of course, has been a stock market darling, but you have a slightly lower credit rating on National Bank. Why is that? Simply because it's a smaller business?
It's a smaller business. It's heavily concentrated in Quebec from our perspective. But with the impending CWB acquisition, as things move forward with that acquisition, we will be revisiting the rating.
What could prompt you to move the Canadian banks up to AAA territory?
Well, they are currently constrained under the Fitch Ratings criteria by the Canadian operating environment, which looks at business risk and the GDP per capita. What's constraining it right now is the heavy indebtedness of the Canadian consumer. So as that eases versus other G7 nations and other developed markets, if that operating environment score does improve from a Fitch Ratings perspective, that could allow for an improvement in the ratings of the Canadian banks.
And sorry, just to return very briefly to your negative outlook on TD Bank. Now, as far as I know, they got a pretty good balance sheet. I know they took a hit with this $3 billion or so in penalties, but they have quite a bit of capital. Why are you a little more cautious on TD Bank right now?
And we would agree with you. They have a solid balance sheet and a solid financial profile. What we're looking for is more in terms of the impact on the franchise, particularly the U.S. franchise, from these AML issues and as they try to remediate. So if we see that there is any weakness or weakening in that franchise, and if that should start to impact profitability, that is where our view would imply a downgrade.